So Dave McCormick, thank you so much for coming to Bloomberg. Welcome. Good
Happy
have
to
you
be here. Thanks.
So as they just said, the voice of God, as we call him, just said you're co-CEO of Bridgewater, the largest hedge fund company in the world. Very prestigious, important position. You differ from some people who might have what otherwise might be thought of similar positions, because you went to West Point, you were a ranger, you went up to captain in the U.S. Army, and then later on in your career, you served in the United States Treasury under Hank Paulson during the great financial crisis. So you bring a somewhat different perspective than some people who have really grown up on Wall Street might have. In your present job, how does that change how you approach that job? What does it tell you?
Well, I think the Ranger School training was pretty good for Bridgewater. I mean, that was good. That was good. That was
You're
good
that honest
preparation.
with each other in
Yeah, that's
Ranger
right.
School, is that right?
Well, all kidding aside, the thing that we're trying to do at Bridgewater is really create an elite investment organization where you're constantly improving, a learning organization where you're constantly improving through feedback and transparency and merit-based thinking, and that's really what the elite units in the military are trying to do. So believe it or not, there are lots of parallels, and Ray would often refer to Bridgewater as the Navy SEALs, intellectual Navy SEALs, and I've finally got him to talk about the intellectual Army Rangers. But that's one thing that was really relevant to my current responsibility, is trying to build and lead an elite organization. And the second thing that was relevant was the experience in the government, where I served in the Commerce Department, where I was in charge of export controls of sensitive technologies, very relevant to today's discussions. And I was in the White House, where I was very involved in the trade agenda and economic policy more broadly, working for President Bush. And then I was in the Treasury during the financial crisis, working with Secretary Paulson. And so being in those roles gives you a sense of how policy is made. When you're reading the G8 statements, or you're reading how policy is evolving, you can sort of imagine what's really going on. You know a lot of the players. So it gives you an intuitive sense of what's going on in policy. And there's really, if you think about our lifetimes, it's hard to think of a period where markets and what's happening in markets is influenced by the policy process and politics as it is today. So that was really relevant. The thing that I didn't know, and the 10 years at Bridgewater has helped me learn a little bit, is the machine-like way of thinking about markets, the connections between the forces that shape asset prices, how to think about that in a systematic way where you're building understanding. So I sort of came to Bridgewater with some of that intuition, but not a lot of that fundamental understanding, and I've built a little bit of that up since I've been there.
As you talk about that, another thing that strikes me is the question of accountability. I mean, at Bridgewater, presumably, you have a lot of accountability. You have to return. You have to have returns for your investors. In the military, how do you have accountability? And even more important, at Treasury Department or Commerce, because there's a perception in the U.S. government there's not a lot of accountability.
Well, the balancing act that's different really from both of those places, the military and the Treasury, versus what we're trying to do at Bridgewater, is you're trying to create both accountability, where people are responsible for their actions and their performance, but also an environment where people argue and push back, and you can have a very merit-based way of determining what's true. So it's not always the case that the more senior person knows what's going on. And so creating an environment where ideas are debated and the merit of the idea rather than the seniority of the person prevails is really the goal of what we're trying to do. And it's very different than the military for obvious reasons, where you have very hierarchical, and even in the government to some degree, a very hierarchical process. The other thing that's different is transparency. In both of the military and government service, there's not much transparency. Well, when there's transparency, full transparency, and everybody can say what they think, it creates a pressure and an accountability in ideas. Well, you say something, and have 10 people say, no, that doesn't make sense. That's very different when you're operating behind closed doors.
So apply that to present day. Start, for example, with where we are with the global economy. We've had now 10 years of growth in the United States, right? I think later this month we're going to set a new record, global growth. We had it in part because of quantitative easing and some of the actions you took with Hank Paulson and your team at Treasury. Where's the next 10 years of growth going to come from?
Well, as you say, we're long in the tooth on the expansion. And we're starting to see, and that growth has been highly affected by an enormous amount of stimulus, both fiscal stimulus and monetary stimulus. And now we're in the late part of the cycle where you're starting to see growth slow, And in a normal environment, policymakers would take a certain set of actions, and the central banks would lower rates and so forth. We're not in a normal environment. Because of that prolonged period, the tools that are available to conventional tools that are available to policymakers are not there today. So we have a gauge that we monitor, which is called fuel in the tank, which is the combination of monetary and fiscal policy that's available to policymakers. It differs a little bit by region of the world, but the by and large is it's significantly lower than it was during a period when I was in office more than 10 years ago. And so the ability of policymakers to respond is much more limited. And so you're in a very narrow band. It's like policymakers are walking along a ridgeline, and there's a very narrow band of flexibility they have at their disposal. And the situation's much more complicated because a set of externalities as well, or things that are not in their control. One is the trade dispute with China, or the broader dispute with China. We can talk about that in a minute. Another is some of the challenges in Europe, the risk of Brexit, the rise of populism in the United States and abroad. So policymakers are much more constrained than they have been in the past. And that suggests that if there's a real downturn, they may have to rely on even more unconventional policies to stimulate the economy, something that would be very difficult and also very controversial.
So even as we speak right now, the Fed is meeting out in Chicago. They're starting their first of 2 days of meetings right now in Chicago, with a lot of expectation in the marketplace that there's going to be rate cuts. More than one is what's priced in the market right now this year. Is that going to have a material effect on growth?
Well, of course, what the Fed does will have a material effect on growth, and how it relates to expectations will have a material effect. And the challenge, of course, without opining on what the Fed may do or may not do, is that the risk is very asymmetric. And so this is the challenge that central bankers face, whereas if they tighten too quickly and stall the economy with low fuel in the tank, their ability to respond to that is much more limited than it would have been under a conventional environment. Whereas if they stay easy longer, and then ultimately inflation picks up faster than expected, their ability to adjust to that and raise rates and so forth is much easier. And so it'll be interesting to see how that plays out, but it's a tough hand to be able to play.
As I said, you were at the Treasury when the great financial crisis, and people did a lot of things to prevent a depression, I think it's fair to say, which what the risk was. At this point, what do you see the preparedness, the options, the toolkit, as you might put it, when there's a next downturn?
Well, if you think about that famous Mark Twain line, which history doesn't repeat itself, but it rhymes, there's, I think, some of that potentially going on today. So the next crisis, the next challenge that policymakers face is unlikely to look like the one that preceded it 10 years ago. But what's different today, unfortunately, is the tools available, as I just described, are much more limited than they were at my time. They're much more limited in a conventional sense in terms of just how much capacity the economy has to respond. They're somewhat limited in a structural regulatory sense based on some of the changes that have been made from a legislative perspective. But I think the most important thing is they're more constrained than ever because of the politics of the day. So if you go back to those days during the financial crisis 2008 period, it was very controversial, but ultimately both parties came together to take the steps that happened under President Bush and President Obama. And if you look at the level of polarization today in the United States, I think it's very difficult to see how you could get some of the alignment that would be needed. And then if you imagine a crisis in Europe, the challenges are even more profound.
So when you take a look at all that you just described, relatively low fuel in the tank, as you say, global growth that appears to be slowing or at least going sideways, some real risks. How does that change your investment approach, your investment thesis at Bridgewater?
Well, I think we deal with some of the biggest global investors in the world, and I think the headline is that the conditions I described create a level of anxiety about the future and then an enormous amount of uncertainty. So the question is, how do you play that level of uncertainty? And the answers are likely to be around a balanced portfolio that's going to put you in a strong position to be able to offset that risk. Finding high quality sources of uncorrelated alpha are a really necessary part of being able to build a great portfolio, and recognizing that your confidence level about your selection of any particular asset class should be appropriately humble because of the enormous uncertainty that exists today.
Is it much more difficult today to find uncorrelated alpha, as you described it, than it was 2 years ago, 3 years ago?
Well, it's always been an incredibly hard thing to do. We have been in that business for 43 years and have been able to achieve that with a good bit of success by compounding the learning and the understanding. And so it's a constant game of trying to maintain that edge because the world's getting smarter, the markets are getting smarter, the investors that you're side by side with are getting smarter. So it's the relentless pursuit to be able to maintain it.
One of the things I think the markets have not been getting smarter about is how to anticipate China-U.S. trade relations. I mean, they certainly were badly caught out in the last 2 weeks when President Trump started tweeting about more tariffs. What do you make of that? When you were in Treasury Department, your responsibility in part, as I understand it, for Hank Paulson was to deal with the Chinese who were holding some U.S. paper, particularly Fannie Mae, Freddie Mac, things like that. Is China today the same it was in 2008, 2009?
Well, it's in some ways very different, but I think there's a broader picture which our current circumstances is really part of an arc of history that I think is really important to start with, because you essentially have this unbelievable economic machine in China and a great rising power economically, a rising power geopolitically, with the relative gap in global influence and economic impact between the United States and China closing very, very quickly. And there's lots of historical precedent for the dynamics of a rising power. As you know,
many of which have not ended well.
Many of which have not ended well. Graham Allison is a well-known political scientist at Harvard, has written about the Thucydides trap, which is the likelihood of conflict in that circumstance. And if you think about the U.S.-China relationship, this was the case 10 years ago, but more so now than ever. That will be the defining bilateral relationship of our lifetimes. The people in this room, that will be the defining relationship. And so, and it's going to be very difficult to manage because of very difficult views of different views of the world, a different way to think about running a country, and the dynamics between the two. So that's the headline. And whatever happens in the near term with the trade negotiations, it will take place within that arc of a very challenging relationship that could be, on one hand, just strategic competition. On the other hand, if not managed well, could become much more combative. And so the question is, how do you manage it well? A level below that, the last few years, and in particular the last 10 years, have created some very challenging dynamics. In the U.S. side, there is a growing consensus, a consensus that's been achieved in recent years on both parties, that the relationship between the Chinese in economic terms has been unequal. If you go back to when I was in the Treasury or in the White House and you talk about the aspirations around market access or intellectual property or tech transfer, those expectations haven't been met in terms of what policymakers had hoped for.
Did they live up to the WTO commitments?
I think largely to the WTO commitments, but in many ways not some of the other commitments. And so, so there's a growing consensus, and President Trump did not show up and make this an issue. He campaigned on this issue, and so regardless of what one thinks about the tactics, what he's representing is a bipartisan view. So that's one dynamic. On the other side, you have in China an enormous amount of growth in capability over the last decade, following the financial crisis, which they weathered extremely well. The rise of President Xi, who has laid out an ambitious role and ambitious vision for China in the world. And so those two things are coming together within the context of a trade discussion. But the trade discussion is emblematic of a much broader strategic discussion of how are we going to be with each other in the world.
The United States has a very powerful economy to this day, and it's still growing. It's in good shape. At the same time, does it have some built-in disadvantages in some sort of a rivalry with China, particularly in the political structure, the extent to which the President of the United States still has to be accountable to Capitol Hill, to constituents, things like that, and also in the time horizon over which they think. At least it's generally thought the Chinese think in terms of much longer time horizons. We think if we're lucky in 4 years, 2 years, maybe even shorter than that, maybe quarter to quarter. Does that give necessarily in that rivalry, as it plays out over time, does it give the Chinese an advantage?
Well, there's advantages and disadvantages on both sides. On the Chinese side, you're absolutely right. So many of the people that are in the key positions are the people that I got to know and work with in key positions 10 years ago who were in key positions 10 years before that. So the continuity, the consistency, the sophistication, the understanding of the U.S., the understanding of the circumstances is very significant. There's a very competent set of people there that are also managing an incredibly challenging economic growth story in their own right. The challenges they have are very significant within the Chinese economy in terms of managing their debt and ultimately bringing the rural part of their economy into the cities and transitioning from the dominance of export-led growth. All these things are very challenging, and they're managing them very, very, very well. On the U.S. side, there are both advantages and disadvantages that come with our system. One of the advantages of our system is the dynamism of our economy, which has been one of the reasons that you have seen some of the growth that we've seen, and you continue to see the innovation, the productivity, and that's one of the driving concerns around the technology, which is really at the heart of the disagreement. What's happened in the last few weeks or so, which I think is, raises some questions of whether they're going to be able to reach an agreement, is that the discussion has gone from a market access discussion and a tariff discussion to the weaponization of exports. And you see that with the Huawei entity list, and you see that on the Chinese side with rare metals. And so those are very significant technology decisions for both parties. And you see that with the rhetoric on both sides, the rhetoric on the US side and the rhetoric on the Chinese side. And so the question will be how we manage through this last phase. There's lots of incentives to find an agreement of both parties. There's lots of cost in not finding an agreement, but there's also a growing risk of that both parties have created on both sides through the way they've spoken about this publicly and so forth, of getting a bad deal. And so how that's managed will be a real challenge.
Is the Trump administration correct, as far as you know, in saying there is a real national security risk of things like Huawei, not limited to Huawei, but like Huawei, that goes well beyond trade and commerce? I mean, you said you were responsible for export controls, for example, at commerce. You know this area. Are they right about that, or is it overblown?
Well, without speaking on the specifics of China, that risk is a very real risk. If you think about the United States is the innovator and the driver of much of the technology innovation in semiconductors or artificial intelligence or whatever it's been over past decades, the challenge is to manage how companies are able to share that technology in global markets in a way that doesn't undermine their competitive advantage or the competitive advantage of the United States. So that challenge is a very profoundly real challenge. It exists on two fronts. One is giving away the store in terms of that technology, which ultimately creates an indigenous capability somewhere else. So the economic cost associated with that. And then the other is these technologies are very difficult to define as commercial or military. Most of them, or many of them, are dual use. And so how that technology is used and by whom is a really key parameter. So the by and large is yes, I think it's a real thing. The actions that the Trump administration took were within the context of new legislation that had been passed that put additional constraints around the CFIUS process for inbound investment as well as on export controls.
At Bridgewater, you take a long-term view on investments. Famously, Ray Dalio has talked about that a fair amount. Putting this against a larger backdrop, the President of the United States, Donald Trump, came in saying, I don't like multilateral agreements very much. I like bilateral. How does it affect potentially longer-term investments for Bridgewater and others if, in fact, there is a transformation, maybe even a breakdown of many of the multilateral structures that were created after World War II that we've relied upon, and they've served us in pretty good stead so far?
Yeah. Well, I think what's going on in our country is really a reflection of a broader set of forces, and President Trump's election was really a reflection of that. So the concerns about multilateralism, the fears regarding China, the evolution of technology and the displacement of jobs as a consequence of it, income inequality, the wealth gap, all of these things weren't created in the last 2 years. These are, in fact, the reasons that I believe that President Trump was elected, because of that sense of disillusionment that exists. And so the answer to those challenges is a much more fundamental question about, rather than who's president, it's really some of the key things about how we're going to address those questions as a country. And I agree with you on the fact that the post-World War II institutions that were established were absolutely reflective and responsible for some of the great benefits the United States has been able to realize. They're also outdated in some way, and they need a refreshing. So I think some of the critique of NATO is a very appropriate critique. Some of the critique around the WTO is a very appropriate critique. I'm not saying wholesale, throw out those frameworks, but they need to be refreshed in light of the changing dynamics in the world. Just let me give you an example of China. If you look at the institutional framework, and we dealt with this in the Bush administration, the institutional framework that exists in the IMF or the World Bank or the multilateral institutions, China plays a relatively small role in those institutions, yet is the primary driver of global growth. So these institutions have to be updated to reflect the reality of the new world, and also to reflect the fact that the United States' relative influence is more multipolar than it was when we, at the end of World War II.
Speaking of updating, there's some updating going on at Bridgewater. Not that it was outdated the way it was, but there was a fellow named Ray Dalio who founded your firm, and he pretty famously has been talking for some time about succession, about really organizing this so it goes on past him, and you're right in the center of that. Give us an update. How's that going?
Yeah, well, I came in 2009, and at that time we really, he and we laid out a 10-year plan for transition. Knew it would be very hard, knew we'd make a bunch of mistakes along the way.
And you just had your 10th anniversary.
I just had my 10th anniversary, so who would have thought? And there were 3 pieces to it. One was thinking through the ownership transition of Bridgewater in such a way that as Ray transitioned, that it would remain employee-owned, employee-controlled. His relative ownership would go down, and others would take on that ownership by buying him down and so forth. And so we've worked through that with a good bit of success over the last 10 years, and he still remains a very significant owner, but the ownership is spread much more broadly across the firm. So the second piece was institutionalizing the culture. So if you think about these founder transitions, one of the things that is unique about Bridgewater is the culture, and if you think about that being critical to the success, how do we maintain that as we get to the next generation? And so we spent a lot of time on reinforcing that, writing it down, building tools that ultimately reinforce how we operate, making sure the next generation of leaders are aligned with that. And as the CEO, co-CEO, that's one of the things I think about a lot, because if you can get the culture right, lots of other good things follow. And then the third thing was management. And so after lots of fits and starts and a good bit of failure and good learning from that, we've landed on a design where we've got 2 co-CEOs and our 3 CIOs who lead our investment, Ray being one of them, and hopefully Ray will continue to do that, and I suspect he'll do that for many years to come. And so far so good.
Does your role continue to evolve?
It does. Yeah, it really does. We're spending a lot of time on building out our governance structure. Everybody needs to have appropriate governance to ensure that we're ensuring the right checks and balances. I continue to learn a lot. Sort of like 2 steps forward and all the great learning, and 1 step back where you mess that up. And now, believe it or not, my mindset is saying, okay, how do we think about succession over the next generation on the investment side, technology and management over the next 10 years? Because that's ultimately the most important thing a leader can do, is make sure that the next generation is prepared to be successful.
Dave, thank you so much.
Thank you.
Ladies and gentlemen, Dave McCormick.
Thanks.